we are looking at the CBOE equity put call ratio, and the current number is like 0.65. This is pretty low as compared to what that was there in the beginning in January. What this implies is that there is a laid back tendency among the investors, and this is a good sign that the market may twist and they may, currently the trend is bullish. They may change the direction to a bearish tone. So, with that context in mind, let's go and take a look at other charts. So let's take a look at VIX. The VIX is currently at 17.18, which is like pretty a low as compared to what it was in the last 1 year. So this is like again a very laid back tendency among the investors, and the volatility is much lower at this point, and anything lower than $15 is like there's an extreme bullish tendency among the investors. Now, let's compare that to the realistic situation. Inflation has not gone down. We still have the inflation. The eggs prices are not as low as what we used to know, at least in 2 years back. We have a slight cooling effect on the inflation in the last um, 6 months plus, based on the interest rate hikes from the Fed. But inflation is still higher. So, because of this reason, there is a greater risk in the market. And so, the volatility at any point in time can shoot again all the way up to 40 or even 80, based on how the events unfold during the time when the volatility starts shooting up. Because of the situation, it's best to go and buy certain puts, as the puts premiums will be lower considering that the volatility is pretty low. The puts premiums are calculated based on the volatility, and since volatility number is very low, the long-term puts are nominally better priced at this point. The zero dated options may not be much cheaper, but or anything in the short term duration may not be cheaper. But then the long term option puts are pretty much okay, because the VIX values are more normal at this point. Considering the things that I explained in this video, um, if we have to choose a single stock or single ETF based trade for this month, or for the next 2 weeks, then anything related with VIX is the best trade that I can think of, because VIX is at all time lows, and the related ETFs like VXX, which is a 1x, and then UVXY, which is 1.5 VIX, and then we have UVIX, which is 2x derivatives VIX. There is a greater chance for VIX to go back to, let's say, $30 or maybe more than that. And so, what it means is, if you buy one of these derivatives, you are potentially looking at 50 to 100% returns. So here is a chart of UVXY. The current price is about $3.8. So let's revisit what's the price in about 2 weeks, just to see how things are working. And we'll also take a look at UVIX, which is a 2x leveraged ETF. There's a greater chance that we are going to see much bigger shooting there. And then we can also take a look at VXX, which is 1x leveraged ETF, and we'll take a look at it, how it performs. So now let's take a look at S&P 500 for the last 6 months plus duration. And if we see that the S&P 500 is moving up and down and with no clear direction, and it's like more the stagflation theme that is ongoing at this point, with no clear understanding whether there is a bearish or a bullish momentum. So I do not think there is any big change that's going to come, because there's zero dated options are there, and the short term options are priced in such a way that any major movements are almost very difficult for the market makers. But since I discussed about the other things that in this video, there is a greater chance that there is going to be a small, 5 to 10% drop that can be possible on the S&P 500 at this point. Having said that, is it going to be a real bearish thing? We do not know. There may be a catalyst that may come back at a later point. That may push the panic button among the investors, and we may go and retest 350 or probably even go down to 300 or anything more, but it's too early to guess that. We'll have to watch the events and then make a decision based on that. This point, what I can see is a 5 to 10% drop, and this is where the UVXY or VIX based play is best suited. Now let's take a look at the stocks that had the biggest options volume today. The newcomers are Bank of America at the number two spot. The other newcomer is Charles Schwab. Other than this, we have the same set of stocks, which is Tesla, Apple, Amazon, Google, with no major changes. And so that means we are going to have certain kind of small movements only at this point. As I said, we are looking to go bearish at this point because of the volatility situation as well as with respect to put call ratio. So we'll have to watch this and then take our decision based on that. Another thing to watch is how the bonds are performing as against the S&P 500. So if you look at the 3x leveraged 20 plus year treasury TTT ultra short, ultra pro short, this is going at 3%, and this is being bullish along with S&P 500 being bullish. This is not making sense because in terms of correlation, it's always the opposite. So what it means is somebody has to give up. At this point in time, I really see that we will give up on the equity side. So S&P 500 has more reasons to drop, and this is why the UVXY or weeks based plays are much more superior at this point in time. Another thing to note down is that S&P 500, if you look at the 4-hour chart, it looks like when we see the MACD patterns, there is a crossover that is happening. So it means that there is a directional change that is possible in a short time. So which is also indicating and helping our case on VIX UVXY based plays, or a bearish momentum for a short term. Though I'm not perma bull or a perma bear, we are in a similar situation where we used to be in 2008, and so there is a greater chance that there can be a big drop in the S&P 500, and there can be a very huge bearish momentum that can come in. So we have to make our plays in such a way that we are not affected. This is where UVXY or VIX based plays looks very superior. So if you want to be on both sides, I would say a better trade would be holding 80 or 90% of your portfolio in the best stocks or S&P 500, SPY or QQQ, and have the remaining in UVXY just to balance things off. Yet there will be a small damage to your profits, but then you are safe to handle any kind of extreme risk situation that can happen, especially with the put call ratio at its lowest or near the low point. There can be a major shift in the market momentum at any point in time, so you got to be prepared for that. So with this, we come to an end of this video for today, and if you like the video, please like it and subscribe to my channel, and I'll be posting more videos, and keep in touch. Thank you.